Today, I'll examine the purpose of the modern corporation and the broader responsibilities that come with operating a business in society. At the center of this discussion is a fundamental question. What does a corporation exist to do, and whom should it serve? We'll trace the shift from shareholder primacy to stakeholder responsibility, considering how changing expectations have reshaped the mission of business. This gives us a foundation for understanding corporations within the broader context of business environments and concepts. A corporation is more than a business name. It is a legal entity that exists separately from the people who own it, which means it can hold property, sign contracts, and face legal action in its own name. Its separate legal identity creates three important advantages. Limited liability generally means owners can lose only what they invested. Perpetual existence allows a corporation to continue even when ownership changes. And transferable ownership means shares can be bought and sold, making it easier to attract capital and support growth. This slide introduces the shareholder primacy model, a way of thinking that shaped corporate decision-making for decades. Its central idea, captured in Milton Friedman's 1970 statement, is that a business's social responsibility is to increase its profits. Under this model, managers were viewed primarily as agents of shareholders, responsible for maximizing financial returns. Profit, efficiency, capital allocation, and share price became the dominant measures of success. Other social or environmental considerations were often treated as secondary to that central obligation. This slide introduces a central debate over corporate purpose. Should a company prioritize shareholders above all else, or balance the interests of everyone affected by its decisions? The shareholder view emphasizes serving investors first. By contrast, the stakeholder model, championed by R. Edward Freeman, argues that durable success depends on creating value over the long term for employees, customers, suppliers, and communities as well. The key issue is whether business success is measured narrowly by investor returns, or more broadly by sustainable value for all stakeholders. In 2019, the Business Roundtable, representing 181 of America's largest corporations, announced a significant change in how it defined corporate purpose. The shift was from shareholder primacy to responsibility toward all stakeholders. That means creating value for customers through products and services, while also supporting employees with dignity, diversity, and fair compensation. It extends to suppliers through fair and ethical partnerships, and to communities through environmental protection and local support. The statement signaled a broader view of business success, one that balances financial performance with social responsibility. A corporation's stakeholders extend well beyond the people who own its stock. Shareholders provide capital and expect financial returns, but employees also create value through their labor, skills, and loyalty in exchange for compensation and opportunity. Customers are equally central because their purchases and use of products give the business its purpose. Finally, society and regulators include the communities, governments, and environment affected by and capable of constraining corporate activity. The core idea is that corporate decisions must account for this wider network of interests, not just investor returns. Corporate social responsibility, or CSR, means integrating social and environmental concerns into everyday business operations and strategy. It goes beyond simply meeting legal requirements. The goal is to create a positive impact while conducting business responsibly. CSR includes philanthropic efforts, such as donations, community programs, and employee volunteerism. It also involves ethical practices, including fair labor standards and responsible supply chains. Environmental responsibility focuses on reducing emissions and using sustainable sources. Finally, businesses can support economic well-being by creating jobs and strengthening local economies. Together, these areas define a broader view of business accountability. ESG standards give investors and the public a broader way to evaluate companies, extending beyond financial performance. The key idea is that corporate behavior has multiple dimensions. Environmental criteria examine issues such as carbon emissions, climate risk, resource use, and waste. Social criteria focus on how a company treats employees, supports diversity and inclusion, protects data, and affects its communities. Governance looks at how the organization is directed, including board structure, executive compensation, transparency, and anti-corruption practices. Together, these standards provide a more complete picture of corporate responsibility and long-term conduct. This slide challenges the idea that businesses must choose between profit and purpose. Strong values can build trust and loyalty, while sustainable revenue provides the resources to reinvest in those values. The market examples reinforce that connection. Patagonia's environmental mission helped create a fiercely loyal customer base and a billion-dollar brand. Unilever reports that its sustainable living brands grew faster than the rest of its portfolio. And at Microsoft, Satya Nadella's culture-first reset supported the company's most profitable decade. Purpose and profit can reinforce each other when they're integrated into how a company operates. Corporate governance is a framework that determines how a corporation is directed, controlled, and held accountable. It includes the rules, practices, and structures that shape relationships among management, the board of directors, shareholders, and other stakeholders. The key idea is that governance turns corporate purpose into consistent behavior. It clarifies who makes decisions, who provides oversight, and how responsibility is shared. Good governance aligns what a company says it values with how it actually operates, creating accountability in practice rather than leaving it as a statement of intent. To wrap up, corporations are legal entities, with rights and responsibilities separate from their owners. Their purpose now extends beyond profit, as stakeholder value gains importance. CSR and ESG increasingly influence reputation, investment, and performance, while strong governance keeps decisions accountable to the corporation's values and obligations.